Okay. Good morning, good afternoon, good evening, depending when you're listening to this. Welcome to another live stream property update. If this is the first time that you're joining me on one of these calls, well, then welcome. And really, what I do in these monthly updates is just talk about some of the macro and microeconomic trends that are affecting the South African economy and us as property investors in South Africa. So today we're going to be addressing some of those concerns. We're going to be talking about the end of the cheap money era, the potential of recession, which is still a big fear for 2023. And then on the lighter side, there's been some unexpected growth. So South Africa's GDP has actually been higher than most analysts had expected. So there might be some sun at the end of the rainbow. First of all, before we get into the content, please go and check out my membership page. You do get access to exclusive content, and I also analyze deals live on your behalf. I received an email from YouTube this morning giving me a snapshot of some of the stats for the year, and it was quite awesome to see that we had broken over 1 million minutes of view time, which is kind of crazy, and then 150,000 total views with just under 3,000 new subscribers. So for everybody that's on the other end of this call that has been listening to me mumble and jumble for many, many moons, thank you for being a subscriber. Thank you for joining the tribe and liking this vibe. There's tons of content still to come. So let's start with the macroeconomic factors and some of the updates from that side. Uh, Obviously, we live in a global economy, so what happens on other sides of the world will affect us in South Africa and will affect the property economy. The main things that I think have been really felt by us as South Africans and consumers is the rise in living costs. You know, the rise in petrol prices. Luckily, that's starting to come down, and there's some hope that there will be a reduction in the petrol price in January. So hopefully that starts to ease some of the pressure, but also the cost of food, just the general cost of living, has substantially hindered and crippled our economy. And this has really been because of the war in Russia and Ukraine. Because Ukraine is such a big grain provider and Russia is such a big oil producer, there's just been a bit of a negative flow of supply and demand that's come into the place. And yeah, I think going into Christmas, it's going to be a tough Christmas for a lot of South Africans, myself included. No one really expected this rise in living costs. Some of the other macroeconomic factors that we need to look at are the risks. We're in a global economy, so it's important that we understand what the risks are facing the globe because that's essentially going to impact us. So the graph that you're seeing here is from a website called Visual Capitalists. I would definitely recommend that you go and check them out. They do very cool designs and infographics. And on the left, you can see what the high impact is. So high impact on the top, low impact on the bottom, and then your probability is on the x-axis. So what we're seeing here is that on the top left, you've got your high impact, low probability. So it'll have a big impact on the economy and on the global landscape, but it's probably got a low probability of happening. The US dollar losing reserve status, the Eurozone breaking apart, the Asian territorial disputes escalating into violence. So that's obviously the China and is it Taiwan? I always forget, but there is definitely some tension within those two Asian countries where China is trying to take control and take over. So if that escalates into the Ukraine-Russian type war, that could be a very, very big impact to inflation, to the global economy. In the middle there, you've got deglobalization. On the right-hand side, high impact and high probability. Those are the ones we obviously have to keep a big eye on. The big one is probably Russia cutting off gas to Europe, which has a high probability of happening. The China zero COVID policy, luckily, we've seen in the news that the Chinese government is starting to fall back on its COVID policy, and that's important because China is one of the biggest producers of everything. Everything is made in China. So when you've got hard lockdown happening in China, that's going to affect the supply in South Africa. That's going to make things even more expensive. The iPhones that are all built in China are now going to be even more expensive because there's less supply. Food and security crisis, again, with Ukraine being such a big provider of grain, that's a huge issue. And then soaring energy costs in the US. And then on the bottom right, we've got low impact but high probability. There is definitely going to be a stronger regulation of cryptocurrency. Again, in the news, we've seen Sam Bankman fraud. I actually don't know what his real name is, but he's basically defrauded billions and billions of dollars from people who bought into his crypto dream. And then something a little bit more closer to home is the emerging market sovereign debt. We're getting into a debt crisis where we have too much debt that our GDP and that our economy is not strong enough to service that debt. And getting into a default status could be detrimental to our economy. So those are some of the main geopolitical risks that I keep a tab on. And I think that, if you're looking to invest in the property economy here in South Africa, it's something that you also have to keep tabs on. The thing about these kind of risks, like the Russian war, it almost seems like it doesn't impact us, or it shouldn't impact us because it's such a long distance away. But what you have to understand is that each country is like a little business, and the Russian business, for example, is a massive oil producer. So as they go into a war and they start to not be able to deliver the oil that they used to deliver pre this war, that's going to affect us. That's going to make our petrol prices higher. But then on top of that, you've also got every other business that uses petrol also has to now go higher. So all of your logistics business, so your food business, now the transport of the Granny Smith apples that you love to eat, are now costing more because the petrol prices for these companies to travel the apples from the farm to the grocery store and basically to your house has now gone up. And that's this thing called inflation, right? As things get more expensive, it starts to affect us as the end consumer. The price, the buck stops with us. This is also another interesting map where we're looking at essentially the risk value associated to each country. So your light green is your low risk, your sort of turquoise, I guess, is medium risk, your orange is sensitive to risk, and then your red is high risk. And how they determine these risk factors are on five main things. So you've got your economic risk, which is around monetary policy and economic structure. You've got your political risk, so policy effectiveness, corruption, that kind of stuff. Structural business environment, so is it an easy place to do business or not? Commercial risk, so this is your short-term demand disruption. And then you got your financing risk, so your risk of short-term disruptions, and your policy around finance. So South Africa is sensitive to risk, is in an orange stage, and it has been for a long time. I think we are still a developing country, and there is a risk factor associated to investing in South Africa, and that's why I think it's important that the returns speak to those risks. That's why I always talk about a gross yield of 15% or more. And that's why I talk about a return on investment of 12%. And that's why I talk about, aiming for 15% internal rate of return. These returns are important because they justify the risk of us investing in a higher risk economy. If you compare this to Australia, to the US, to most of the Eurozone, those are low risk areas because they've got strong economic stability, they've got strong political stability, they've got a good business environment. The commercial risk and financing risk are quite low. So here's some of the good news. The GDP forecasts for South Africa are higher than analysts had expected. So again, the slide might be a little bit overwhelming, but these percentages are essentially the forecasts for 2022 and 2023 for all of the different countries on what their GDP, their gross domestic product growth would be. So if we look at South Africa, South Africa is sitting at 1.9%. So, that's pretty good. That's real growth of 1.9%. I think in the current climate and, with our political instability and with our economic instability, that's a pretty good number. So, I think there are brighter days ahead. I think we're still going to go through some some tough times next year. I don't think inflation has peaked, and I think our interest rates are still going to go higher. But this is going to become a good market for investors, right? It's going to become a buyer's market. The more that the consumer is under pressure, the more that you're going to have sellers flood the market, and you're going to have good discounts to be had. This slide is really cool because I think this leads into the narrative of why inflation has gotten so bad, and the reason why inflation has gotten so bad is directly influencing the interest rates. The reason I've put this video together at this time is because we've recently had the Reserve Bank raise interest rates again, and there's panic on the streets because people are like, when are these interest rates going to stop rising? I can't afford my bond anymore. I can't afford my car anymore. My credit is going up. And the reality is there's many things that influence inflation. We've spoken about the rise in petrol costs and food costs, and we've spoken about, the war other side of the world that has a direct impact on our thing. But another big reason why there's been inflation is because there's been such a massive increase in the amount of money that's been printed. And that's what this slide is showing. You can see that this purple line is the amount of money that is supplied into the economy. And this is money that is either cash or checking accounts or mutual funds. So what we saw here, if you can see on your 2022, right on the right hand side, because of COVID, we saw a massive decline in GDP. The economy started to crumble. People were panicking. So what did what did the central banks all over the world do? They just started pumping money into the economy. They printed more money and they lowered interest rates to stimulate more credit. So you can see that there was probably more money was printed and stimulated into the economy than ever before in history in the last 2-3 years. So the central banks, they did what they had to do. They had to try and stimulate the economy. They had to try and normalize the economy. But now that the economy is normalized, now you've got all this extra money that's been pumped in, and we're seeing inflation. We're seeing now the rise, or the consequence of that decision. So this pretty much sets the narrative as to why we've still got this inflation problem. And the inflation problem isn't solved just yet, but there is some good news. It looks like inflation has peaked in the US. And as South Africa, we tend to follow the US in terms of their data. So, there is a sign that maybe inflation is starting to ease and that the Reserve Bank is ending the tightening cycle, but it's not over yet. I think we need to realistically still be expecting another maybe percentage hike in 2023 before the Reserve Bank feels comfortable to be able to stop that. So inflation affects everything. Inflation affects higher costs for food, higher gasoline prices, higher utilities, higher rates on your home loan. It makes our cost of living situation even worse. And that's why we're in this situation, guys. That's why we're in Christmas, or we're nearing Christmas time, and people are worried about how they're going to afford to buy their kids presents and how they're going to be able to. I saw a stat on the news the other day that said many South Africans are using credit just to buy food. Scary times that we're in. So this slide here is showing the interest rates of prime lending in South Africa. This is from the South African Reserve Bank website. You can see that the stats are from 2012, December 2012. So this is effectively a 10-year cycle that we're seeing here. So over the past 10 years, we started at 8.5. We then rose. We went through a cycle of tightening monetary policy. So from 2012 through to 2016, we saw a tightening, which means that the Reserve Bank is increasing interest rates because they're fighting inflation. Then sort of going into 2017, there was a little bit of easing of monetary policy. And then 2020, what happened? Obviously, COVID happened. So there was a massive decline or a massive easing of monetary policy. The Reserve Bank went from, roughly about a 10% down to 7%, which was one of the lowest interest rates we've seen in a long time. And it's actually quite interesting. When you've got low interest rates, you've got cheap money. And you get a lot of growth from cheap money. You get all these businesses that start taking a lot more debt out because it's cheap, and they want to then start expanding. And you've got a lot of, first-time buyers who buy homes and buy cars because now it's cheap, And a lot of the people that have bought during COVID, didn't think that, okay, at some point there's going to be a reversal, that you can't have cheap money forever. So we had this cheap money scenario for a while. And then as the economy started to recover, the reserve banks realized, oh my word, inflation's starting to go higher and higher. We've had the highest inflation in 40 years is what we're currently experiencing. So we're in a tightening cycle. We went through an easing cycle here because of COVID. Now we're going into a tightening cycle because of inflation. This is all normal. This is all, if you've been following the data, if you've been following the CPI data, this doesn't come as a surprise to you. And this is why I've been hammering this into my students' ears to say work on a 10, 11% prime rate. Even when COVID hit and the prime lending rate was at 7%, I was still telling my students to run their numbers on a deal at 10%. If your numbers work on a 10% or 11% prime lending rate, then the deal is good. If the deal only makes sense because we're in a 7% environment, well, then as soon as the numbers come back to what they're supposed to be at 10, 11%, your deal's going to crumble and you're going to be stuck in a situation where I think a lot of South Africans are stuck, where they've got now too much debt and they have to now start selling their properties to get out of the situation, which is good for us as investors, right? Because you're going to have a flood of sellers come into the market. More interest rate hikes means people who weren't budgeting for it are now in a situation where their expenses are too high, their bonds are unpayable, and they're going to have to liquidate. They're going to have to foreclose. They're going to be repossessed. Unfortunately, that's not always a nice thing. But with more sellers coming into the market, with more distressed sellers coming into the market, there's better discounts for us to get. So, is this the end of cheap money? I think we've definitely seen the cheapest money, the cheapest amount of credit in a long time. This graph here is showing the last 25 years and a bit of a projection into 2024. So you can see that we had some terribly high interest rates in before 2020, and then there was a steady decline, and sort of the average for the last 10 years has been 10%, which is why, again, I recommend to my students using a 10% figure. So we are at the end of the cheap money cycle. I don't think we're going to go back to 7% anytime soon. That was the lowest that we'd ever been in 40 years or 30 years based on this chart. We're not going back there. So yeah, I hope that you've budgeted your numbers to use more of a 10% interest rate as opposed to 7%. So here is some good news. This is from Reuters. I took this afternoon. It looks like the analysts are expecting South Africa to end the tightening cycle in Q1. So the expectation, or what the analysts are saying, is that another 50 basis points, another 0.5 percentage will be added to the repo rate and thus to the prime lending rate. And that would be the end of the tightening cycle at the end of Q1. So I mean, these analysts obviously have a lot of information and they're more intelligent than me. So I'm inclined to believe them, but I'm working on 100 basis points. I'm working on 1%. I think we're gonna get to about 11.5% prime lending rate, and that's when the Reserve Bank will be comfortable, because then inflation should have tamed, and hopefully will lead into more of a easing of monetary policy. So the reason why I put this video together was because of this, right? On the 25th of November, I received this SMS, and I'm sure a lot of other South Africans received this SMS, that your credit facility or your bond or your debt or whatever account that you have has increased by 0.75 in line with the recent South African Reserve Bank repo rate increase. So what impact does this have now on us as consumers as well as on our investments? So on the consumer side, obviously an increase in your rate means your bond repayments are going to go up. So your car loans, your house loans, your credit card facilities, any time that you're taking money that you don't have to spend on other things is now going to go up. On the plus side, all of your accounts, your savings accounts, your bank accounts are all going to go up, right? So there's a negative side in terms of your debt becomes more expensive, but also your fixed income assets also start to go up. On the investment side, an increase in in interest rates is notoriously bad, or historically bad for equities. So, I mean, we've seen the S&P 500. I took these stats a couple days ago, and you can see that the S&P 500 for this year, if you look at the bottom right of your screen, you'll see that we've been in a negative of 16%. Now, I've put quite a bit of money into the Nasdaq, into the S&P 500, into all of these equity funds. And my portfolio is probably at about minus 36, 37% the last time I checked. So it's been a pretty tough time in the equity space because of this tightening monetary policy. So it's interesting how all of these different knock-on effects have such a big impact. You've got this guy in Russia who is creating so much havoc for all of us, and it's funny how decisions that happen in a different country have a roll-on effect and affect us, and then affect the equity market, which affects our pension funds, which affects our investments, which affects our bank accounts, which affects our bond repayments. It's hectic, man. Very hectic. So let's bring it a bit back to home, and let's talk about the South African property economy and what some of the stats are there. So I've got a whole bunch of reports and different graphs that I'm going to show you. I hope that is not too overwhelming. It's important that you stay abreast of these things, and if you don't want to do it yourself, if you feel that this is too overwhelming and you don't want to be looking at all the reports, then just subscribe to my channel and check out my market updates. I do one of these every month or every 2 months, depending on how much activity there is, and I try and demystify all of these fancy, funny reports and give you my opinion as to what's going to happen in the property market. So starting off with Cape Town, Western Cape. Oof, this is a hot market. So from a rental perspective, and I know this because I currently live in Cape Town. I used to live in Joburg, but I moved to Cape Town a couple of years back. And my girlfriend and I decided to move out of our house and to downscale. So we were staying here on the right-hand side here. This is an area called Mully Point. So we were staying, in a very nice house that we had gotten a great deal for because COVID, right? So we moved in 2 years ago and we were paying 30 or 40% less than what you could normally charge in that area because there was such a low demand. So we moved out at the end of November, and I think I went and viewed about 30 houses to go and move in, or to go and get a new rental agreement. And every single time I went to go and view the property, by the time I'd finished the viewing, the agent phoned me and said, sorry, the property's off the market, it's already been taken. The amount of demand that landlords are seeing in Cape Town is it's crazy. It's absolutely crazy, the amount of semigration that's happening towards Cape Town and the amount of popularity that's come back to Cape Town, guys. It's absolutely crazy. What you had is when COVID hit, your short-term rental market in Cape Town completely disappeared. All the Europeans, Americans, and all the people from overseas that would come and do short-term rentals in Cape Town disappeared. So these properties on the coastline that usually were filled with Airbnb tenants were now empty, and people like me and other ordinary South Africans could now actually afford to stay there because the rent was so little. Now, COVID's ended, people are traveling, demand is back, people love living in Cape Town, Europeans and overseas people love coming here because it's super cheap. So all of these places are now full. And there's a big drive from inlanders, or people from Joburg, Gauteng, from Eastern Cape. Apparently, Eastern Cape has had the most people leave the Eastern Cape. I think the last time I checked, it was about 500,000 people had left Eastern Cape to go and live in different parts of South Africa. So there's been a massive influx. This is one of the hottest rental markets I've ever seen. The only way that I was able to actually get a place to rent is by agreeing to pay the landlord 2 months deposit immediately. So I went and viewed the property, and while I was there, I went onto my banking app and I paid her and I signed the lease. Otherwise, it was gone. Crazy. Western Cape is also leading Gauteng in residential developments. So this graph that you're seeing on the top left here is showing the volume of developments that are happening in Gauteng and Western Cape. So you can see the dotted lines are showing you the trend. So there's a downward trend of developers in Gauteng, and there's an upward trend, slightly upward trend of the number of developments going up in the Western Cape. The number of properties in Cape Town almost doubled since 1994. So what does this mean? What does this mean for you as an investor? For me, I'm aiming to put about 30% of my portfolio into the Cape Town market. Cape Town is notoriously known to be cash flow negative. It's very hard unless you're doing Airbnb or student accommodation or maybe some of the commercial retail space. You're not going to get cash flow positive. You don't have your Heilbrows, Bereas, and that kind of high yielding market in Cape Town. It's just not really there. But so my plan is to put 70% of my portfolio into Cape Town because I think that that's where your biggest appreciation is going to be. Whereas 70% of my portfolio will stay in Joburg, being my cash flow portfolio will stay there. Here is the latest capital appreciation data. So Western Cape is just under 6%. I remember the last time or earlier this year, I think it was in April or March, I did a stat like this, and Western Cape was sitting at like 3.5%. But remember, it was COVID times, and there was still a lag of the demand. Now demand is back. Now properties are starting to appreciate. Eastern Cape is doing well, 8%. Mpumalanga 7.89. Northern Cape 7.74. Gauteng is still very disappointing at 3.2%. This is a very interesting slide because this shows the top nine suburbs, the top nine suburbs in Gauteng where developers are focusing. 9 of them are in the affordable housing space. So you've got Riverside, Soshanguve, Windmill, Savannah City, Midstream. Okay, Midstream Estate is obviously the outstander. That's not affordable housing. But everything else is affordable housing. What does this mean? It means that people are realizing that affordable housing is where the market is. That's why these developers are going towards affordable housing because that's where our market is. And that's why I focus on affordable housing because that is where the money is. Okay, this is a nice slide to give you a residential rental market update. This is just at a glance the way the performance is. So you've got 4 different stats here. Starting at the top, you've got your escalation rate. So within your rental market where people are paying less than 3,000 Rand, which is the column on the left, your escalation is 3.66. Your 3,000 to 7,000 is at 2.3. Then you've got 2.78 for your 7 to 12,000, 3.2, and 3.2 for your 12 to 25. So your escalations are not great at any one of these rates. Then we've got the vacancy rate, which is your next column or your next section. So the vacancy rates are sitting at between sort of your 6.5% to 7.5%. Then you've got your good standing. That's the important one, right? That's the chance of delinquency. Now, under 3,000 is your highest risk market, and you can see that you're only getting a 68% good standing, which means 32% of the time people are not paying their rent, right? Then you've got 82, 88, 87, and then a low performer on the right here over 25,000, 77% of the time they pay on time. And then your rental value segment, that's basically saying how much of the South African economy rents at that level. So 54% of South Africans rent between 3,000 and 7,000. So this big chart here, the biggest column, that's the column that I focus on. That's where my market is. I like the 3,000 to 7,000. That's the affordable affordable housing space. The reason I like it is because 54% of South Africans are renting at that space. So where's the demand? The demand is for affordable housing. It's got a decent of good standing ratio. 82%, 83% of the time people are paying on time. The vacancy is okay and the escalations are quite low. So that's a nice at a glance. Let's get into a bit more detail. So here we've got the SA vacancy rates since 2017. Now this data is from a report known as the RERD report. It's a paid for report, but it's really reputable and gives great updates of the property sector every quarter. So what we're seeing here is that from Q2 of 2020, again, this is the COVID narrative, we saw a massive increase in vacancy rates, and that increase has started to come down as things have started normalizing. So I'm assuming that by probably Q1 of 2023, we'll probably see, it fluctuating back to the average of about 6-7%. Here we've got the percentage of tenants in arrears. Again, we've got the 2020 COVID narrative that kind of spiked the data. It's now starting to average down again. And this is data from PayProp. Now we've got the SA residential rentals picking up to nominal terms. So what we're seeing here is essentially the rate at which the rental escalations are happening. Sorry about that. My headset sometimes just goes on sleep mode. It's probably sleeping because I'm talking so much. Anyway, this is the rate of change of rentals. So we're starting to see, again, a lot of the data suggesting that COVID had a big impact. We saw a big decline in a lot of areas, and we're starting to see a recovery. And again, here we're starting to see a recovery. Hopefully we get back to, the normal rental escalations of 5 to 7%, which we saw pre-COVID. This is probably my favorite slide. The percentage of owners selling due to financial pressure. Now, I hope that I'm not coming across as cold or, as someone who enjoys to see others going through a hard time. I don't. I absolutely hate seeing us as South Africans struggle and the cost of the rising cost of living, decimating and destroying livelihoods. I absolutely hate it. Unfortunately, I also see the opportunity of people who are going through hard times who need to sell their liabilities, and me being able to take over their problems as an opportunity. I've seen a lot of people go to auction, lose their property, and not only lose their property but still be liable for the outstanding debt plus get blacklisted. One of my favorite stories is a guy I helped a couple of years back. So he was about to go to auction, and I actually stopped him from going to auction and bought the property before it went to auction. Now, why it's a cool story for me is because he had a massive problem, and because I was there at the right time, I was actually able to help him. So how it works, right? If let's say you buy a property for R1,000,000, okay, and you've got R1,000,000 debt on it, and for some reason you can't honor your obligations, and the bank takes over that property and repossesses it, and they go to auction. And they go to the auctioneer and they say, auctioneer, please sell this property. The guy can't pay his debt anymore. Sell it. And let's say the auctioneer gets an offer of 800,000 that the bank accepts. So there's 200,000 outstanding, right? 800 was accepted, but the outstanding debt is R1,000,000. The bank will then take that 200,000 Rand, go to the seller and say, you have to sign an acknowledgement of debt. So you still owe us that 200,000 Rand because the bank's not going to take a loss. So the bank will associate or take the 800 and then take the difference, the 200,000, and put it onto the seller's name or onto the person's name. So that's crazy. So the person loses their asset and is still stuck with more debt. Plus they get blacklisted, which basically means that they can't get another loan, a car loan, a credit card. They can't even go to Edgar's and get a bloody store card. So so I had the opportunity with this one guy to at least cover his debt. He wasn't blacklisted. He can now go on with his life as if nothing had really happened. So, yes, we do look for financial pressure. We look for good deals. We look for discounts. We look for motivated sellers. Unfortunately, that's the nature of the beast. But you also get to help people out of tough, tricky situations, which I'm really grateful for. So here is just some highlights from this road report. Firstly, the residential market continues to slow. So we're not seeing the growth that was anticipated by analysts, both from a rental escalation and capital appreciation perspective. Here are some of the big highlights of Q3. So, many continue to be negatively affected by the South African economy growth due to high inflation and higher interest rates. And some people warn that the worst is still to come, that 2023 is going to be a recession, and that right now we need to start buckling up for some rough roads ahead. The industrial property market, especially warehouses, has seen a strong demand. So that's a really good sector to be in if you've got the appetite. Green shoots are appearing in the office property space. but fundamentals for commercial are still very poor. The capitalization rates of the retail property market are edging up. So that's a good sign if you are in the retail space. And then flat rate vacancy rates and rentals have improved further, but still not where they were. And they're still not seeing any real growth. At this stage, the impact of interest rates are only having a marginal impact on prices and volumes. So that's a good thing. So far, there hasn't been a massive impact on the volumes or the price bands for properties based on the most recent interest rate hike. This is one of my last graphs. I know there's been a lot to take in, but maybe you can watch this video a couple of times or just focus in on the areas that you're interested in. This is the capitalization rates for A grade offices. Now, this is only relevant, capitalization rates are only relevant for commercial and industrial properties. You don't really use the capitalization rate when you're looking at residential. But what the capitalization rate allows you to do is it allows you to value different buildings or investments in a specific area. So what we're seeing here, what I can read from this data is that between 2006 and 2018, the capitalization rates, the rate at which commercial deals were growing was quite low. In fact, I mean, it was only really Randburg that was peaking above 10%, or peaking towards 11%. So that is quite low. We're seeing a bit of an uptick. So we saw obviously the decline in cap rates because of COVID, and there's been a steady capitalization rate rebound, which is quite nice. So if you are in the commercial sector, you should probably start seeing a bit of demand, more people coming into the offices and more companies needing office space. So we've come to the end of my presentation and the end of another, what I hope is a successful year for you. And I wish you and your family and your loved ones nothing but good times and blessings for the future ahead. I hope that you take some time this month to review your year, to look at some of the highlights, some of the lowlights, to reflect on what you've done well, what you haven't done well, and then hopefully to set some really good, ambitious goals for next year. Because it's December time and I've done my review, here are some of the highlights from my year. So it's been a pretty tumultuous year, but one of the highlights has been the finance that I've been able to raise. So this year I was able to raise 7.5 in private finance, mainly through my YouTube channel, which is just crazy. People watch my stuff and then they reach out to me, and we discuss buildings, we discuss investments, and they end up giving me some money to go and buy buildings together and to do like a Stockfell crowdfunding scenario to grow our wealth. And then 2.5 was raised in institutional finance. The purchases that I did this year was one student deal with a 20% internal rate of return. I bought two new builds, both negative cash flow, no surprises there, with a negative cash flow of 1.5. You might be asking, why did I do that? Well, I want some exposure to the Cape Town market. I want some exposure to that capital appreciation, and because I want the Section 13 Sex Act, which gives you a nice tax rebound when you buy into a new build. And we are busy finalizing our first commercial purchase, which will have an internal rate of return of 18%. So that's where that private finance is going towards. So hopefully, in 2023, I will be doing a case study of my first ever commercial purchase and start demystifying that side of the journey. So I hope that your highlights are up and coming. I hope that you've done what you wanted to achieve this year, and if not, then this is the perfect time to sit back and reflect and to project what it is you want to achieve next year. What do you want to make happen next year? So that's the end of my final update for the year 2022. It's been an up and down year. It's been a crazy year, but you know what? As South Africans, we are resilient. We are strong. We are determined. We are entrepreneurs. We are fighters, and I hope that you will continue this fight with me. If you haven't done so already, click that subscribe button, click the little notification thing, click the bell, share this with friends and family, tell other people about this. Yes, I am shamelessly promoting my own stuff, but please, guys, I'm sharing as much knowledge as I can for free about the property landscape, about generational wealth. If you can If you see any value in what I've done, and if you think anybody else can benefit from this, please share it with them. We need more financial literacy in South Africa. We really, really do. And yes, I get paid by YouTube for having content, and I get lots of back end sales from this, so I do benefit a lot. But I've also created this YouTube channel because I do believe in generational wealth, and I do believe in creating some level of equity in this country. And if we can get everybody on the same playing field in terms of their financial knowledge, maybe we can make that happen. So it's been a plum pleasing pleasure and a privilege to be with you tonight. Thank you for joining. Thank you for listening. If you have any questions, if you have any comments, please put them in the links below. And if you want to reach out to me to chat about a partnership, to get some coaching, to just talk about the property economy and market, then again, in the link below, you are welcome to schedule a call with me. Until next time, happy investing.